since Levi and I have started, like the majority and the bulk of everything we've done has been in the Mountain West, stuff that's in our backyard. And so I didn't really work a lot of broker relationships. But like I feel like we have like a competitive advantage buying deals in the Mountain West because like we know our markets so well. We're able to act quickly. And like the Boise deal that we bought, the broker called Levi because they had a long-lasting relationship and said, "Hey, we see what you guys are working on. We think this deal would be the perfect deal for you." And, we ended up winning it because of that broker relationship.
What's going on, everybody? Welcome back to another great episode here on the Multifamily Wealth Podcast. In this episode, I'm chatting with two great guests, Joe Rinderknecht and Levi Allen, Cowboy Capital, a couple of Utah-based multifamily investors. And if the name Levi rings a bell, it's because he's been on the show before. Really, really knowledgeable investor, and I appreciated our first conversation so much that I wanted to have him back on the podcast. And since then, he has started working with Joe to take down multifamily deals kind of throughout the Mountain West region. They've done some stuff in Utah, done some deals in Montana. Now they're doing a deal down in Texas. But Joe's got an interesting story as well, and we get into that here in this episode, as well as Levi's. Joe shares a great story about how his first deal did not go well and how he had a whole bunch of investor money in it. And he talks about what he did to just scrape and claw his way through that deal and as a result, earn the respect and trust of the investors that participated in that one, despite the deal not going, as originally according to plan or as according to projections. And Levi, we get into a whole bunch of stuff that he's worked on as well. And Levi is an extremely, I think he thinks about valuing multifamily and actually evaluating deals and evaluating markets in a really unique way. And I think, we get into that in this episode as well. But another big story that they shared is how they found this insanely good deal on LoopNet, which I always love to hear a story about how somebody finds a killer deal on LoopNet just because, the rest of the industry says that that's not possible. But they just do kind of a deal diary deep dive into this whole deal they found on LoopNet, some of the challenges they had with it, what they did with it, what they're selling it for, and we get into a whole bunch of other fun topics along the way. A couple of great guys, Levi and Joe, and I think that all of you are going to very much enjoy this episode from an entertainment standpoint as well as a value standpoint. So be sure to stick around and give the whole thing a listen here. And if you find, or I should say, if you learn anything on this episode, please consider leaving the podcast a rating and review, as I always request. And again, appreciate you all for listening, and I'll catch you guys on the next episode. All right, I'm joined here with Joe and Levi, Cowboy Capital. For those of you who have listened to the show for a long time, Levi's name might be a familiar one. I was on the podcast, I believe, 2023. I got to go back and look, but we had a great conversation a couple years ago, diving into his story. And now I got him and his partner, Joe, here on the show to talk about what they're working on within Cowboy Capital. So this is a rare dual guest episode here on the Multifamily Wealth Podcast. So we're going to manage best as we can here. We're going to get double the insight in half as much time. I think that's how I'm going to kind of frame this one. But looking forward to chatting with you guys. And let's start with just a high level on the backstory here for both of you. And Joe, if you'd like to start just a high level on maybe what you were doing pre-real estate and how you got into the business. And then maybe we'll segue over to Levi's quick story there as well.
Yeah. Thanks, Axel. Really appreciate your podcast. I've listened to a handful of them and love what you're giving to your listeners. And yeah, so a quick story. Usually I'm wearing a cowboy hat. I forgot it today because it's really kind of the brand. And I grew up ranching, farming. My last name is Rinderknecht, which is really interesting because in German it actually means keeper of the herd. So since essentially the beginning of time, we've been ranchers, and I broke the mold. But anyways, started in farming, ranching. I think the biggest thing, like with Cowboy Capital, is like when working on the ranch and farm, right? You learn how to work hard. You learn that what you say is your bond, and your bond and your word is everything, right? Especially in our business and having high integrity. And so, anyways, started in that world, and my dad got into construction at an early age. And so he was kind of the black sheep of the family. He decided not to stay on the ranch because like my uncles and cousins are still on the ranch. My dad went into construction, and that's how I naturally got into construction as well. I'm the oldest of all my siblings. And so I was the one who, would go help him all night long, right? We were trimming out spec houses till 2, 3 o'clock in the morning while I was in high school. So, and then I've been in different trades within construction. So I really got a good understanding of how construction works, which has really served us today collectively in our projects. And we'll talk more about that. So pre-real estate, I was really in the labor force, construction, and I drove semi from 2015 to 2018, which really isn't that long ago. Got into real estate back in 2016, 2017. I bought my first duplex in 2016 just because I needed to. Yeah, my wife and I bought a duplex that we house hacked because at that time we were living with my in-laws and working for my in-laws, and that was not a great place to be. So it was more out of necessity that I got into it. Then we bought a fourplex, and pretty much from there, I've flipped handful of small multifamily, and from 2019 to 2021, I really believe in like the apprentice concept, if you will. And I went and worked for a property management company, and I worked for a couple sponsors around the country, essentially doing my best to learn from those who were doing what I wanted to do and learning everything there was to know about multifamily. And like the property management, I manage an 80 unit Section 42 LIHTC property, right? So if any of you know LIHTC, that's a tough asset class to manage, but it really helped me cut my teeth and has given me a love of, the property management, construction, asset management aspect. So I didn't buy any deals from 2019 to 2021. 21 bought a 24 unit that we turned into 32 unit. That was a deal that, you'll find with Levi and I were very transparent. It was a deal that went sideways. We had to pause distributions. We had to do a capital call. Construction, it was largely construction costs, and we got taken for a ride on a couple by a couple contractors. But, I had a couple partners that kind of fell off and did a lot of like I showed up and my partners sometimes did too, like 3 to 5 days a week for 3 years to keep the deal alive. And even though that was a really tough time of my life, that 3 years of pretty much making zero income, it has really, really helped Levi and I in our business today. And investors that have come from that deal are, some of our larger anchor investors today. So that's kind of a quick storyline from beginning to now.
No, I love that. I mean, I love how you highlighted kind of the concept of the apprenticeship model there, where I think just fundamentally speaking, and this is more or less the path that it sounds like you took, I don't think enough people who do what we do start in property management before they get into buying deals, raising capital. And they lack the operational understanding of how real estate actually, where the income comes from, where it goes, and how do you keep folks in units. Like those fundamentals, I think, are critical to really understand before you can actually operate an asset, even if you're not the one who's property managing it. There's some sense of you need to understand the core parts of that component of the business to really efficiently and run, or I should say, efficiently run a property and run it well. Levi, quick refresh on your story, and then interested in how you guys met each other and started working together.
Yeah, I'll try to keep it fairly brief. I believe it was 2021 when I was on the podcast last. So
It was 21. That's right.
been
Yeah,
four
even
years
longer than
ago.
20.
But yeah. So yeah, I grew up farming and ranching similar to Joe. A lot of the values that we've integrated into our company today, we feel like we were installed in us at an early age, just because in the farming and ranching community, there's a lot of like your word is your bond, you do what you say you're going to do. There's a lot of handshake deals. Your reputation means everything to you. People do business with, who they know, and everyone knows everything about everyone and like the ranching and farming community. And so yeah, we feel like we've really integrated that into our business. But yeah, let's see, 2017, I bought my first deal, 8 units. That's the one I talked about a lot on your podcast, I believe. Then I bought a 10 unit deal the next year, 2018. And then 2019 was the first syndication. And then, yeah, I've done, I think, 12 syndications now, most of them in Utah, a few in Texas, two in Montana now, one in Idaho, Boise, Idaho. And then, yeah, but let's see, I met Joe back in
It's 5 years ago.
2020, I believe it was. Yeah. We just started talking and like underwriting deals together and looking at different opportunities. There was a deal in Missoula, Montana that we looked at together back in 2020, I think, or 2021. And we got outbid dramatically on it, but we just stayed in touch, and we realized that like our personalities are opposite, our skill sets are opposite. We really just started to work really well together and just growing the relationship over time. And it wasn't till about a year ago that we closed on our first deal together, which was 54 units in Missoula, Montana, which has been a home run of a deal. If we have any time to talk about it, we can, but we've almost doubled the value in 1 year on that deal. And we raised the full equity stack as preferred equity because at the time that's what our investors wanted. So it's going to be a huge, like a $3 million profit for us when it's on the market. We're actually switching brokers to a national broker. But yeah, so over the years, we've just figured out kind of our lanes and what we're good at. And we've started to, yeah, just work. We formed Cowboy Capital earlier this year. And it's just, yeah, been a blessing to really figure out what we're both good at. And it's really taken off. We've done, once we close this 292 unit deal in San Marcos, Texas, that we're closing this week, it'll be 4 deals that we've closed together within the past 12 months.
Nice. Yeah. And it seems, as you mentioned, right, there's complementary skill sets. I mean, I'm going to just go ahead and make the assumption based on the stories here that Joe, you may be handling a little bit more of the operational asset management construction side, and Levi, maybe it's more fundraising, acquisitions. Is that kind of the more or less the complementary nature of the two skill sets there?
Yeah, essentially. Levi's the deal junkie. He deals with like a lot of the lender relationships, the broker relationships. He's even better at the legal than I am, and I really enjoy like the details, the nitty-gritty, yeah, property construction, asset management, and yeah.
Yeah,
And,
I
and I
think
think the benefit too is that like, and we both collectively do like capital raising. I think the benefit to like our partnership is that we can each do each other's job. So it's like if
mhm.
we need to, if he needs to step in for me, he does, and vice versa. So I think that's what really makes it powerful is that we've both been doing this for about a decade now, that we can still jump into each other's shoes when it's needed.
Yeah, absolutely. I mean, I think that's kind of like partnerships 101, right? It's complementary skill sets, somebody you enjoy working with, and if you have shared values that, you're kind of knocking the big stuff out. But let's start talking about some of the, more nitty-gritty real estate stuff here. So I want to start with the market because I think a lot of the folks who listen to this podcast maybe either A, don't look at deals or haven't really spent a lot of time evaluating, maybe call it the Mountain West area, if I'm just going to broadly define the entire region of where you guys are operating, Utah, Montana, etc. I'm in the Northeast, and it's a similar dynamic where, New England is not a nationally discussed like multifamily housing market, at least to the extent that the Southeast, Southwest, Texas markets are. And I think it's interesting in that you guys are doing deals in Texas, but you're also doing deals up, call it Montana, Utah, etc., which probably have very different dynamics between those two. I don't know, either one of you can take this one, but in terms of comparing and contrasting the attributes of those two markets and maybe why you like each for maybe their own individual reasons, that would be interesting, I think, to hear about and for the listeners to learn more about.
Yeah, I can give my quick overview on it and then Joe can add to it if he wants. But it started out just because it's kind of what we knew. Like we're from here, we have a lot of family here. Utah. We spent a lot of time in Utah. So northern Utah, you got the Wasatch Front. It's a mountain range on one side, and then you got the Great Salt Lake on the other side. So it's kind of land constrained to a degree. That theory's kind of been proven wrong over the past cycle of supply. Like you think like, okay, like you can't really build that much, but it has gotten oversupplied, like Salt Lake City proper, especially. The more suburban markets are already stabilized, like back to 94, 95%, and starting to get some rent growth. But downtown Salt Lake is still pretty oversupplied and concession. It's all getting absorbed, but there's most properties are offering like 2 months free concessions still. And then all these markets are different. Like Montana, Missoula, Montana, similar thing. Like the geography, it is landlocked and constrained, but more so the city, it's a little bit liberal and it's a little bit hard to get things approved. We've heard of projects taking like up to 4 years to get through like full entitlement. And there's also like not a ton of private land in the city limits. Like there's a lot of like public land and stuff. So for various reasons, it's been really supply constrained, and that market has continued to see rent growth and price appreciation over the past 5 years, while a lot of these other growth markets have seen so much supply that has pulled rents back and concessions, and home prices have kind of dipped a little bit. And then Idaho, it got a lot of supply, but it's kind of bounced back a little faster than Utah. And I'm talking Boise, Idaho. We own one deal there. They're already starting to see rent growth again. But yeah, all of these markets have good job growth, good, business friendly, landlord friendly. There's good growth. So really you kind of just got to watch that supply and be careful, because there's certain pockets that don't have as much supply. And so, yeah, there's a lot of research you got to do there, but there's probably some other things Joe could add.
I mean, yeah, the thing that I would add to this is like, I mean, since Levi and I have started, like the majority and the bulk of everything we've done has been in the Mountain West, stuff that's in our backyard. And so, since like Levi specifically, I didn't really work a lot of broker relationships, but I feel like we have like a competitive advantage buying deals in the Mountain West because like we know our markets so well. We're able to act quickly. And like the Boise deal that we bought, the broker called Levi because they had a long lasting relationship and said, hey, we see what you guys are working on. We think this deal would be the perfect deal for you. And we ended up winning it because of that broker relationship, but still went through the full call for offers and that whole process. But having that local knowledge from brokers and, really staying on the radar and providing really good results on the deals, like always, it goes back to our values, right? We always say what we're going to do. So we're not going to go under contract on anything unless we know for a fact that we're going to close on it. And like the whole reneging, renegotiating is against our values unless like something crazy comes up that we weren't aware of, So, and then like all of our properties, Utah, Montana, Idaho, are a 4-hour drive away. So it gives us speed to solve problems. I know Logan Rankin was on your podcast. I don't know how long ago, but like I know I've been listening to his stuff a lot. Like one of his core values of his company are, speed, right? And the quicker you can make decisions and fix a problem, that will really affect your bottom line. And so that's why we've been investing here. And, you mentioned Texas, like Levi and I I've done some passive investing in Texas. Levi has done more active, but it's like we know the market fairly well. And all of the deals that we've bought in the last 12 months have really amazing stories. And this was another really amazing stories. And so when you can take your existing business plan and pivot to a new market and it still makes sense and you mitigate, different risks that are the highest risks right now with debt and construction, property management, all those variables that really can make or break a deal, it makes sense to go to a different market. But that's largely why we've been on the Western front is, for the reasons I stated. So.
It's funny. I mean, it seems like similar to like our business's kind of trajectory where you start in your backyard, right? It's a lesser known market as it relates to like national commentary in terms of what leads headlines in population growth and rent growth and all of that. For us, that's New Hampshire, an hour north of Boston, right? It's kind of New England. For
Oh,
you
yeah.
guys, maybe that's Utah and then up to, Montana and heading over to Idaho and all of that. But you start to realize as you invest there, like, hey, it's a little supply constraint. Like people are still moving here. Generally speaking, we have some growth, but it's not being met with the adequate supply outside of Levi, maybe in Salt Lake City there where they did build a lot. But once you blend some level of supply constraint or supply constrainment there with population growth, you start to get that outpaced rent growth, which is obviously what we're all looking for. Let's talk about that deal in Montana because I'm interested in that one both in terms of like how it was capitalized, maybe how you guys found it and why it was such a great deal. So I guess starting from the top, like how did that one come to be? Is there a story around kind of finding that deal and why was it such a good one? Like what stuck out to you when you first saw it? And then let's talk about how you put it together.
Yeah, I can start on that one. So Levi and I, we tried buying a deal called, was it
I kind
Missoula
of told him the
Loss?
story of this already.
Okay.
Yeah,
Yeah, so that deal,
2021.
okay. Yeah, so a deal called Missoula Lofts is 101 units in Missoula that he and I took a run at. Sold for, 300K a unit.
Mountainwood Estates.
Mountainwood Estates. What? Oh, Missoula Lofts is the one that
There's
just
one that-
barely sold. Okay.
Yeah.
Deal merge. So when I have like on LoopNet, like a saved search. So if any deal in a certain market with specific criteria pop up, on the market, it hits my email pretty quick. And so it was like a Wednesday night, 6 or 7 o'clock. The deal hit my email. They wanted like 6.5 million for is a 98 built 54 unit. And I immediately, the math is quick, right? It's like 120 and change a unit. And for 98, I'm like, oh man, this is interesting. So immediately shot it over to Levi and we're like, okay, yeah, let's take a stab at this. I emailed the broker right away. He sent financials really quickly. And so we underwrote it that night and submitted an offer by like 10 o'clock the next morning and found out that the broker had like received about 12 inquiries and
Probably, right?
already, right? So we were first to offer on it and we put up like 50K non-refundable day one, like full on released to the seller, right? Like not even just in escrow, like released, gone, right? We toured it first to tour like that Friday, so that weekend. And I guess to make a really long story short there, it came to like the following Sunday. It was only on for like a week and a half, 2 weeks,
No,
wasn't
was
it?
it that? I thought it was that weekend that
Oh,
it
it
happened.
was that
It was
weekend.
just that
While
weekend.
I was in
The
Minnesota. It
Sunday.
was only like from like Wednesday to a Sunday. And by that Sunday night, we had increased our offer from like 6.5 up to 6.8. So we changed our pricing a couple times. We ended up beating out, what was it, like 12, 13 offers. And then so Sunday night is like 9, 10 o'clock at night. The broker texts us and says, hey, the seller has verbally accepted your offer at 6.8, 75K non-refundable earnest money. We'll send you all the docs tomorrow on Monday. Okay, great. Monday afternoon comes, I call Levi and we're like both, thinking the worst. Like, yeah, somebody else came in and outbid us. And that's exactly what happened. We called the broker and said, what the heck's going on? They're like, yeah, as you can suspect, pretty much at 11:59, a local owner who the seller knew submitted an offer at 210,000 higher than ours, so like 7.1. And he asked us, do you guys want to increase your offer to 7, 1.5? And Levi and I, like the one thing I've loved about Levi is he's helped me make decisions quickly. I tend to have analysis paralysis, getting too much into the details. So we got off with the broker. We talked literally 3 minutes and said, nope. Levi, he's willing to walk away from a deal, even though we want it so bad our teeth hurt.
Yeah.
I couldn't believe he was like ready to walk away. And I'm like, dude, this is first deal I bought in like a year, no, 3 years, right? And I'm like, I was having a hard time even wanting to walk away, but like Levi's like, bro, it's not worth it. I'm like, all right. So we got on the phone with the broker and we're just like, listen, you know, we knew the seller was going to sell this property to buy a ranch. And we're like, look, like Levi and I, we come from a ranching family. We believe your word is your bond, and we want the seller to hold to his word. Like we understand 210,000 is a lot of money, and we agree with you and we wouldn't blame him. But you know what? Like, we're going to do everything that we say we're going to do. If we go under contract, we will close on time and we're not going to renege or any of that. And what was really cool is the seller came back and was like, okay, I like these guys' attitude on this. I'll award it to them. So,
Wow.
which was really cool because he walked away from more money and from a buyer he knew personally that had a local presence.
Yeah, that's like the odds in real time of you guys winning that as all that's unfolding are like, pretty low if you were to bet on it, right? I mean, it's a hell of a story though. I think some big takeaways that I pull from that, and you kind of mentioned it like when you mentioned Logan Rankin there in the episode we did on the podcast, which is a great one that folks should listen to if they haven't heard it. But he's all about speed, right? And speed in operations is critical, but speed in acquisitions is just as, if not more critical, right? In terms of when a deal is released by a broker, whether it's LoopNet to an email list, whatever, and it's priced right and people have got eyes on it, like you got to act quickly. You got to move with urgency and move with intentionality. And then actually including a deal term of like, we're just going to release EMD day one. Like that is an extremely attractive term to include in an offer that I think the vast majority of buyers like don't even consider doing that. Like it's a risk that most consider, they don't even consider taking that risk, I should say. I'm sure that probably helped. And then, nothing like a little guilt trip too. Build that rapport, a little guilt trip. You got to do what you got to do, right?
Yeah. Yeah.
Yeah, he had two offers at just over 7 million, and they were both bigger groups. Yeah, one of them was local. But yeah, that's how I was going to start answering this whole story was speed. All of my best deals that I've done, it's been because of speed and knowing the market. So I bought a similar deal. I'm just going to tell like a 30-second
Go for
pitch
it.
of the similar deal that I bought to this, also 54 units in North Salt Lake City, Utah in March of 2024. But like it was the night that I got the financials and it was like back of the napkin stuff because it's a family that had owned it for over a decade and the rents were 900. They should have been 1,500 for this location, like big, really good location just at the bottom of Eaglewood Golf Course. And it's kind of in between like Bountiful, Utah and North Salt Lake for anyone that's in Utah that knows. But anyways, yeah, that deal's been a home run of a deal. We just got approval from Fannie Mae for our refi, and it's going to be a good cash out refi. But yeah, the price for 14 million. We bought it for 9. We put 400 grand into it, and yeah, basically a 14-month turnaround. But it was I guess I left out the part where I submitted an offer the next day, or no, it was that same night that I got the financials, and I did 100,000 non-refundable. And then I started to get into bidding war that next day with another buyer, and I got them to go with mine before it like went to more buyers or it was off market. But yeah,
Hmm.
speed. You got to be quick to get the best deals.
Yeah, for sure. Especially when you got a broker involved, right? And you're competing with other folks, right? I think it's like, if you're direct to seller and maybe it's you and a couple personal friends of the seller, it's like, all right, maybe not. But like, especially in a broker deal where there are multiple groups making offers, like you have to really push the urgency of the entire transaction, or else you're probably going to get left behind by somebody who is. Back to the Montana deal, it seems like this was a deal that was released at a price that was like a no duh, no brainer, of course. Was that because maybe the broker is listening? Probably not. Was that because of some level of oversight by the broker, or was there something going on with the property from like a business plan standpoint that kind of required it to trade at some type of a lower price? Or, what was the
Yeah,
actual
so
business plan with that deal?
the seller on that deal, he was the original developer that built it in 1998. And I can imagine he probably built that thing for like 25,000 a unit in 98. So his
Hmm.
cost basis was nothing. And then over the years, he's just tried to keep it full, as a lot of these long-term owners do, to like minimize turnover, optimize cash flow. And even though his average rents were 783, he was still cash flowing good, based on his basis. And the broker actually told him, I think you should list it at 6.8. And he said, no, I want to list it at 6.5, which is that's kind of rare, but
Yeah.
but yeah, so it was a really low cap rate, like on actuals, but the rent, like this is majority two bedrooms, the property. We've moved those rents. The average two bed was like a little over 800,
Just over 800, yeah.
and now they're 1,550 plus $85 utility fee. So almost doubled the rents.
I mean,
And then
it's double the rent.
the studios and the one beds were a little bit less. They were like a $550 increase. But yeah, just Matt, that was the main thing. He's just owned it that's from my analysis. Was there any
Yeah.
other reasons that?
I think he wanted to buy the ranch too. He owns a bunch of others. He's kind of a slumlord there. I mean, not a slumlord really, but like he's got a bunch of older stuff. And the really funny part about this is he told the broker to list it, and he went on like a 10-day safari hunt, like the day that they listed it. And so like it was that's why we were negotiating Sunday night at like 9, 10 o'clock at night because it was daytime, his time. He wasn't
That's
out
hilarious.
shooting a giraffe or something.
Yeah, maybe the worst time to be doing that is when you are going to go field all a million phone calls from your broker. It's just like, but yeah, I mean, I think if you've been in this business for a long enough time and you kind of deal with value add deals, like you eventually have a whole bunch of these stories of an owner who is like his motivation is just different than what yours is going to be as the new guy, right? It's like, why would he raise the rents and turn them over to go and spend a bunch of money on them to get another few $100 a month when he's like, I don't really need to do that. It's on autopilot. And I'm sure he walked away probably a really happy guy at the closing table when he got his, 6-8 there and change or whatever it was. But the other takeaway too is LoopNet. I guess you can find deals on LoopNet, right? You had a LoopNet alert and you got a deal out of it. I think that's something that most people assume never happens, but
I think
that's a
the
good
biggest
story.
thing too is right knowing the market. Like I
Yeah.
said, like I feel like we have that competitive advantage just because it's like we can easily field a deal that hits the market really, really quickly, you know.
Hmm.
So,
Yeah, I never understand when people say like they underwrite 100 or 150 deals a year. I think I heard you say this too. Like I do back of the napkin
Yeah.
math in like 3 minutes. Okay, they're way off on price, or like, whoa, this could actually have some potential. Like your yield on cost, like, yeah, we move the rents to here. Like, yeah, literally it takes us like 5 minutes to look at a deal and know if it's worth looking into more or not. But
Yeah, and I think that comes with like having spent more time underwriting a lot of deals in the past, right? And having that like real knowledge of the market going like
yeah.
if you're in this range, from a price per unit standpoint and rents can get here and we're going to spend our whatever 15K unit on capex, we got to have a sense of this of, if this is a deal that's actually worth investigating further, but I think it's like a competence breeds confidence type of thing where when you actually spend a lot of time looking at deals in a given market, you start to have all that data that you can reference where it's like 120 a door, like that's a no-brainer. Like, that deal that we looked at 6 months ago sold for 180 or 200 a door, or whatever it might be. Like there's all kinds of margin here. Let's quickly talk about how you capitalized it. And then I want to talk about, I want to switch gears here and talk about investor relations. But I believe you said you used all preferred equity. You mentioned that was kind of what your investor base was looking to do. Why were they looking to do that? What does that allow? What's the upside, I guess, for them? And then for you guys as sponsors and structuring that in terms of how you put that deal together. And then I guess we're going to kind of arrive at closure because it seems like you guys are at least working through the sales process on it right now.
I'll let you talk about the financing,
And then you can talk about the equity stack if you want,
the equity stack.
the
Oh,
preferred equity.
yeah. And then it's okay, Axel, I'll tell you a little about like what we did with renovations because I mean that was
Absolutely. Yeah.
a big part
So
of
that
our
too.
renovation. So go ahead.
So yeah, as you know, Axel, and probably a lot of your listeners, any deals that are kind of like sub 10 million, usually your local banks are the best lenders that are going to get the most aggressive on rate and terms and leverage if you're willing to sign recourse. And we were willing to sign recourse. A lot of these smaller deals we do. So yeah, it was a local bank, Opportunity Bank of Montana. They were a lot better terms in every way than all the other lenders. 80% leverage, loan to value, and then 7.25% interest rate, 3-year term, 2 years IO, no prepayment penalty. And it was like a way negative DSCR going in. So it's basically like a bridge loan, but a lot better rate than like your non-recourse bridge loan. And since then we did a different local bank loan, quite a bit better terms than that even, or two different local bank loans. But yeah, this was a year ago and rates were a little bit higher at the time. But so yeah,
Hmm.
that's how the debt was.
Any construction financing or just purely loan to purchase price and then bring all the construction funds yourself?
It was, yeah, we did have a draw account. So yeah, that 80% was, well, it was technically, I'm trying to remember.
Yeah, it was
Was it
like
eight
loan to purchase price.
loan, but it was loan, I think it was just loan to value, but then they did a holdback on the portion for renovation.
Hmm.
Yeah.
So it wasn't quite as good. Yeah, we didn't get quite as good a leverage as like a loan to cost. But yeah, since then we've gotten a little bit better terms on a different bank in Montana that did give us, yeah, it was 75% loan to cost and a lower rate. But yeah, then the preferred equity investors, yeah, it was how many investors was it?
We were no, it was like 11
11
investors.
investors.
Yeah. Yeah. So at that time, I think the thing too that's really helped Levi and I is like being able to pivot really quickly based on like what our investors' desire is. So like all four of these deals that we've closed in that 12 months have been structured completely different just because like we know our investors. And 12 months ago, as we all know, like debt, hard money was very prominent. And so it was really tough for us to raise, 6 to 8 pref, 70 to 80% performance split. And so what we decided to do is we raised, I can't remember, how much did we raise? 2.8? No, that was Hilton.
2.7. It was 2.7.
2.7.
We put in 650.
Okay. Yeah, so Levi and I both had exits about that time. So we invested 650K of our own money into like the common equity and then raised 2.05 million in preferred equity. And we gave our investors it's like a weighted average 15% pref. So we did a 10% current pay and caught a 5% accrued. It ranged between 12 and 17 based on the tranches. And our investors really liked that. We were able to raise it pretty quickly, got some bigger checks, a couple small checks, and they're going to be really sad because, we bought it for 6.8, put about 400,000 into it, and we're listing it for 11.7 right now. And so, but it gave the investors the 10% and the security that they needed to kind of compete with the debt and hard money investments that we were competing against essentially. So they're getting what they want, but the benefit for Levi and I is that like we get every dollar of that upside, but we also had the most risk, right? If we were to default for any reason, our 650K would be the first to go down the toilet before their money would ever be touched. So it's a really good risk return for us. And it worked out really well. And we've built really good relationships with investors. And we've had multiple investors from that deal redeploy with us on, one or two other deals that we've done since then. And, I'll talk real briefly. Levi and I both have done a lot of renovations in our career. And so what we did when we bought the property is like 95% of the tenants were month to month. And we knew that there was like a really big increase in rents. And we did a $385 rental increase plus like an average $70 utility fee. We were going into it expecting a 50-60% vacancy, like mass exodus, essentially of 50-60% of the tenants. And when we implemented essentially that umbrella increase across the whole property, we actually retained 60% of the residents, which tells us, right, that we bought right and that our rental increase was perfect because a far more of our tenant base could absorb that increase. And so we had about 20 units vacate and we started renovations essentially December 1st and we were done. We renovated 20 units in 4 months, maybe even less than 4 months. That's like a full scale renovation, new cabinets, countertops, flooring, paint, fixtures, faucets, like the whole gambit, right? And what really helped us, going back to like where Levi and I have both done a lot of construction projects, when we were getting bids from local contractors in Missoula, our cost would have been about 20 grand per unit, but we had a lot of relationships out of Salt Lake. And so we brought the big ticket items from Salt Lake, like cabinets, countertops, flooring, paint. And so our cost is like 13,000 a unit on those 20 units. And we vacated all 20 units pretty much at the same time. And we're able to do like all demo and then all flooring and then all paint and then all cabinets, right? So we were extremely efficient through our entire construction process and we're able to lease them up pretty quickly. And what's cool too is like even the ones that we renewed, they've already gone through one, I think, was it one
Two
or two,
different renewals.
two other renewals since. So they've had three rent increases, and we've retained about 75% of our tenants that renewed originally.
Yeah. I mean, I think it's interesting where it's like because we've done a ton of these and it's you're always underestimating the willingness of the current resident, even if they're paying a fraction of maybe what the market rent is to stay. Because at the end of the day, these are people who probably know they're getting a deal. They probably know
Oh,
what the
for
market rent
sure.
is because their brother or friend or cousin or whoever just rented an apartment up the street and they probably ask them what they're paying in rent and they probably, they get everyone has a sense of what their rent should be, right? And I think a lot of people outside of kind of fringe scenarios where the property is truly falling apart where they're like, I'm truly not willing to pay any more because this building is like literally falling apart around me, which is obviously a rare scenario for most buildings that we take over, even ones that maybe need some work. They're like, yeah, I'm willing to stay. If you take me from 800 to 1100 and market rent is 14, I'm going to stay until maybe you get me to 1250, and then I'm willing to spend another $150 to go move into the renovated $1,400 a month apartment or whatever it might be. And I think it's always a surprise when even when we do these deals because very similar type of deal that we buy that we typically see folks who want to stay, even though it's they're in a slightly more dated unit, but people would rather stay where they are, broadly speaking. And it's nice when you can retain the vast majority of the resident base in a building like that when you buy it, just because it makes the whole business plan much easier. I'm sure that's probably what you guys found at that one too.
Yeah.
All right, so we're coming up on time. One more question here before we wrap up here. You've spent some time here. I know, Joe, you've spent some time talking about, you kind of briefly touched on a deal that was challenging, like early in your career there back in 21. Talk about, how important and transparency is with your investors. Like you took a lot of those investors that rode that ride with you, and they're now, more anchor investors in the business. Let's just talk about kind of the general philosophy around communicating with investors within your business. Maybe you start broad in terms of what you like to communicate. Maybe there's some tactical, like we send out updates this regularly, what have you. And maybe talk about how that's become a competitive advantage for you guys comparatively to maybe other folks who haven't done as good of a job, which there are a lot of those, as we both know.
Yeah. Yeah. So this deal in Utah, yeah, when things started going sideways, like I was actually a minor partner and I had only brought about 150K of the 2.05 million that we had raised on that deal. Or no, that was North Russell, like a 1.25 million we raised. So we had two other big investors that brought money. And when things started going sideways, like my partners on like their kind of which is crazy philosophy was like no news is better than telling bad news. And so anytime we ever sent like an update out, we painted it, bright and sunny
Hmm.
and it was all sunshine and rainbows, even when our rate went from 5 to 10%, and because we were on a variable rate bridge loan, and and so like our investors didn't know like really was going on until like we were pretty much going to lose the property to foreclosure, right? And that's when we had to like do a capital call. Like we were originally planning on doing 1.5 million in renovations. I mean, it's a 1951 property, 24 units to a 32 unit. We ended up spending 3 million on the property. Just quite transparently, like I learned so much about construction and everything there on that deal. But as far as communication go, I what I learned from that is even though like a couple of these investors were not my investors, I realized that I had to be the one to communicate with my partners, investors, and kind of go around them because what we were saying was just not true. And it was really going against my core values as a person. And, I got on the phone. I remember I was driving from Utah to Idaho and I was scared to death to talk to this guy and tell him, have that fierce conversation of what was transpiring because I'd heard stories of people getting sued and, getting kicked off and just like that's like the end of your career, right? Essentially in the multifamily industry. And it scared me so bad, but like I'm so grateful that like I overcame that fear, even though like I had no idea what the result or consequence could be of, not telling what was going on, right? So it's good to have those conversations, even if they're not fun. so anyways, what I learned from that and a core value, Levi and I, is like we communicate everything. We run out the bad news and we walk out the good news, essentially, right? Because like we've seen so many sponsors, like we're buying the deal we're buying in Texas right now, like that, and that sponsor is going to prison for securities fraud and embezzling funds and what have you. And when I look at their reporting, they don't show any numbers underneath, the NOI, right? And so like what we do is we make sure everything is wide open for our investors. Like we literally show them everything that they want to see because the second we're not willing to show everything is the minute that we're trying to hide something in my eyes, right? And so so part of our competitive advantage is we do monthly reporting, we do monthly distributions, even if it's a percent or two. We give our investors access to like all of our property management reports, all of our financials for, kind of outside of just the property performance. We show them construction draws. We want them to see a full picture of what we're doing so that there's no questions, right? And what we've even done that we've had a lot of really good feedback on is we started a YouTube channel because what we found is that like our investors that are somewhat sophisticated, they enjoy reading the whole like document, right? But their spouses don't really care about that document. But the spouses are a big part of investing, right? Like if they like what they see, then they would give their partner permission, if you will, to invest
Hmm.
more with us,
Yeah, the
right?
blessing. Yeah.
Yes, essentially. And we realize that like everybody receives information differently, whether it's visually, auditorily, or like by watching something. And so we start a YouTube channel where we update like her construction and showing the progression of, a unit that we're demoing to, it being rented out, right? We show that full progress essentially. So then they can see it and hear it, and then we also build out what's called an asset management plan, which is a supplemental document to our offering memorandum, which goes nitty gritty into the business plan, the roles, responsibilities, who's being accounted, who's needs to be held accountable for which piece of the business, it's property management, construction, even like our insurance or our in-house bookkeeping, like they all have a role within that asset management plan. And we have really found that to be truly effective because like on our Boise deal, we had like signed contracts with contractors prior to closing, and like day one of ownership, we were renovating 3 units, day one, right? And so it goes back to that whole aspect of speed, right? And Logan Rankin, he talks a lot about this too. And that's the other thing that Levi and I have really learned is like the capital raising, the deal finding, the doing the deal is all very sexy. Like the asset management, implementing the business plan is not sexy at all. But like that's the most important part. And so it's like if we can hedge, yeah, and hedge the risks of being able to start day one. And if am I making sense
Yeah.
there?
You're making a ton of sense. Yeah.
Yeah, so it's just like I feel like that's part of our competitive advantage too, because we've had really good feedback from our investors and their spouses on the YouTube channel, our asset management plan, and it's really helped our team because we revert back to the asset management plan when there's questions about, okay, where are we at on budget? What did we agree to? Because it's all clearly lined out.
Yeah.
One thing I just want to add real quick, Joe was able to save that deal and get 100% return of capital to investors.
Oh, yeah.
You guys were probably all wondering.
I was gonna say, like, I'm gonna need the closure on that one
Yeah.
after. Yeah, I mean, because
And
that's a hell of a win. Yeah.
one of our biggest investors. So the capital call was only successful because Joe actually picked up the phone and called all the investors individually and successfully got that capital call done. And one investor that had invested 300,000 originally, he put in 500,000 of the capital call. and he wasn't even Joe's investor originally, and now he's invested over $1 million in our or a million over
He's
a million and a
almost
half.
he's 2 million now.
I guess with Texas too.
Texas, yeah.
Just yeah, within the past year.
And he's on our board of directors, and he's referred us he's referred us over $1 million as well,
Hmm.
another investor capital.
So yeah, I guess the biggest takeaway there is just even when it's really hard and you're scared to communicate the bad, yeah, you got to do it because it's gonna be for the better good for the investor, for us in the long run. You need that trust and to be transparent.
Yeah, 100%. And I think especially with a more experienced investor, which it sounds like this investor probably
He's a
fits that
CFO on the
prototype,
bank.
just based on the dollar amounts, it's like they understand that investing has risks, right? The one thing that they don't want to have happen is they don't want the wool pulled over their head, right? Like I think that's so easy for especially newer sponsors to forget is that like we understand what we're doing when we're in business and we're putting money out to risk. And sometimes stuff happens. And whether it's a massive issue or a small issue, just sharing that I think is critical. And as an LP in some, Texas deals that were bought in 21 at the height of the mania, I didn't want to get the FOMO, so I invested as an LP in a few deals that are obviously, I shouldn't say obviously, but many of them not going well. The most frustrating part for me as that LP is I don't have any sense of the sponsors. I'm not throwing them under the bus or naming names, but like I'm not getting the updates I need or the transparency I need to really understand what the situation is. And I think that is far more frustrating than just having clarity and closure around this is what's happening. This is currently, if I were to be honest, with the assessment of this investment up to this point where my equity might be worth. This is what's coming down the pipeline here over the next year or 2 years. The leaving out information or the dressing it up as maybe not a negative, but as a neutral or a positive is not helpful to anyone, right? And I think, you highlighted that, Joe. All right, we're past our time here, but let's share where folks can reach more about or learn more about what you guys got going on, I should say, and maybe reach out to you.
Right here, Cowboy Capital. Cowboycapital.us is the website. Should we give them our new emails or?
Yeah, it's just Joe and Levi. Joe at cowboycapital.us or Levi at cowboycapital.us. And we're largely like on Instagram and LinkedIn, not as active on Facebook. But yeah, you guys can reach out to us, or we're sending out more of like a monthly newsletter, and actually sending out like we send out a monthly investor update. So we're actually putting that together as like a portfolio update that we'll send out to like everybody in our database as well, just to add an additional layer of transparency to
Love it.
everybody.
Yeah, that's fantastic. I'll link all of that in the show notes there. Levi, I've always enjoyed following you on Instagram. I'm gonna have to drill into find yours if I don't already follow you after this, but I'll link those as well too and get all the socials down there as well as the emails and the website. But great conversation, guys. I think this was gonna be all right. I know it's gonna be really valuable to all the listeners and appreciate you both taking the time.
Yeah. Thank you, Axel.
Yeah, likewise, Axel. Good talking with you.